Good morning. Thank you. Good morning. I see a lot of familiar faces and a couple of new faces, so welcome to everybody, whether you're a veteran or a first-timer, to New Economy, New Rules. My name is David Wong. I'm a partner here at Barnes & Thornburg and the chair of the Internet and Technology Group. And so on behalf of Barnes & Thornburg, welcome. I'd also like to welcome, besides our group here in Indianapolis, we have through video conference people visiting from South Bend in our Barnes & Thornburg office there, and also in Elkhart, and then also from the Purdue Technology Center, Northwest Indiana in Maryville, and the Mid-America Science Park in Scottsburg. I'd be remiss as a technology attorney not to take 2 seconds and just mention that there are some very interesting things happening on the technology front in the legal sector, with the Supreme Court issuing a decision this week regarding patent trolls and making it easier to defend yourself against them. So if you have any questions about that, feel free to find me afterwards. So with that, I will jump right in and hand the mic over to Mike.
Thanks, Dave. We good? Good morning. I'm excited about this one. We've been talking about this for a little bit, so we're glad to have the opportunity to kind of talk about this $7 million fundraise from Battery Ventures for Smarter Remarketer. And the panelists that we have with us today, Angel Morales, here, one of the co-founders and chief innovation officer at Smarter Remarketer. Matt Tyner, the guy who was largely inside the deal as this all went down, and so he's going to give us an inside view into that. Christopher Day, managing partner at Navidar, and he's been involved with several deals around our community, not specifically inside this one, but he's going to help provide some kind of corroborating experience on deals like this one from his experience. So thank you guys all for joining us.
Pleasure.
So you guys know the drill, I think. I've got a roster of questions here that will help to get us kicked off, but I'm sure many of you in the crowd have questions as well. There are cards on your table. Jot down questions if you have them, and somebody will grab them and bring them up to me, and I'll try to weave them into the time as best we can. But let's go ahead and get started. So I'm just going to open it up to you guys. Walk us through how this deal went down and kind of the chronology of everything that happened.
Yeah, it probably started a good 20 months before funding. A battery associate had gained visibility to Smarter Remarketer through another investment that they were holding, a company called Telium, that was a strategic partner of ours. And we had been obviously building for a number of years. Actually, there are a lot of Smarter Remarketer early stage investors in the house, so thank you again. You made all this happen. But we had been in the market. We had been developing our brand and forging a lot of strategic alliances. One of them specifically, Telium, got us introduced to Ben Johnson, an associate at Battery, who then started following us and started talking with some of the retailers that we were working with, started talking with other technology providers that we had partnered with. And as we're on the revenue-producing side of digital marketing, so Smarter Remarketer is a platform that back then was primarily watching what you do on retailers' websites, not the creepy kind, but just observing, and gave marketers the opportunity to react to that. So if you were deeply engaged with a specific type of product, the retailer could trigger an email to you that told you more about that product, helped satisfy the consideration set. So we had really grown with a lot of our retailers, some pretty significant revenue. Battery obviously like that, and the conversations then progressed, really starting to gain traction about 6 months before the funding event, where a collection of meetings, some, we'll call it casual due diligence, just in a more casual conversation, but they were digging deeper, and it was a sign to us that there was genuine interest, and that manifested in really launching into a true due diligence process with us, which is really where my esteemed colleague came in and worked the 80-hour weeks to satisfy their needs. Yeah.
So a couple metrics they shared with us when things started to go from the casual conversations to the more legit with Battery. They wanted to see us get to a $1 million run rate on a quarterly basis. So close $1 million of ARR in 90 days. Once we got to that point, you could see the heat kind of turning up. During the casual conversations, they said that to get to this point, so they followed us for about 12 months at this time, there's about 600 to 700 companies that they're following in one given year. They'll take it from casual to serious for about 100 of those companies, and they look to fund 2. So it's the $1 million run rate that gets you into the group of the 100. It's the 6 months of 80-plus hour weeks that gets you to the 2. But I thought it was interesting that was really their metric, their line, that sort of bumped you over the fence. Okay, now you're large enough, now you have enough momentum to really start to take it to the next level.
Were they very transparent with you about their portfolio strategy as well? You know, a lot of these VCs will say, we're going to do 2 deals in this industry category. We're going to do 2 deals in this industry category. What was that landscape for them?
So transparency in general, I think, is important to touch on. Very honest throughout the entire process. And that sort of lends the question of, are you looking for a VC as a funding source? Are you looking for a VC as a partner? And if it's the latter, the transparency really starts in the casual conversations. So it's questions like that if you don't get an answer, you're sort of feeling them out as well for what their level of commitment is with you. As far as portfolio strategy, I think you can see who they're talking with, who they're taking to that group of 100 to sort of formulate your own idea of what they're doing. But they were at a high level, were sharing information regarding what they've done in the recent past versus where we fit in that portfolio.
Very good. I did launch right into the questions. I didn't give you talked a little bit about what Smarter Remarketer does. Can you give a little bit of, if there's anything, a couple questions. SaaS model, right?
That is correct.
So from, when you're talking revenue multiples and you're talking about what VCs like, that's a good, positive thing as well. Monthly recurring, annual recurring, multi-year contracts.
We do have a collection of multi-years. Most cash flow is always king, and one of the concepts that we really started working on relatively quickly after Battery engaged aggressively, we were doing more of a monthly billing model, and we switched that over to a quarterly billing model. Now we're looking at going a bit more aggressive, and again, just from a cash position, always favorable to.
And you guys have multiple products now, right? You want to talk about how those products fit in and into the retailer experience?
Sure. The problem that we're trying to solve these days is a pervasive problem that every marketer actually faces. And it's this very simple concept that you're going to have display ads out in the industry. You're going to be sending emails. You're going to be communicating with people socially. You're going to have messaging that happens on your website that can be targeted one-to-one. The challenge in the industry right now is there are vendors that do each one of those, and they live in their own bucket. They have their own data sets, which means that the message that you get from the display ad partner versus the message you're going to receive from email can be radically different. Different message, different tone, different offers, and it creates confusion in the industry. And this was it was organic. The industry grew up like this. But now the technology exists that allows us to unify into a centralized platform an understanding of who you are, the message I should be giving to you, and an offer that I should be giving to you. And then you can broadcast that out. Let them use their partners of choice. Let them work with ExactTarget. Let them work with the Tomy from a display ad standpoint. But have a central hub of intelligence that shares those messages out and lets those vendors do what they do best. That's where we live right now. We are, it's called omni-channel marketing. We're definitely at the forefront of it and continue to dive much deeper into that.
We kind of stopped the narrative at the 100 and the 2, but there's probably many cocktails worth of stories about going from 100 to 2 to to actually getting the deal done. Can you give us a
Sure.
quick flyover of how that happened?
Sure. So we had our first semi-serious conversation late July, where the partner that we were working with shared with us that he'll be going on vacation for a number of weeks in August. So life tabled for us. We came off a great closing quarter for Q2. We started Q3 somewhat slow early July. He was going on vacation, so we knew we had to keep our momentum through the end of August to be relevant when he returned. So conversations started to pick back up in September, and that's when we started to get into the formal talks around letter of intent, which we were able to get done with in approximately 30 days. One of the things that we touched on in that period of our discussion was this idea of our organizational form that we went with early on. So we were an Indiana-based LLC at the time, and when they came in, they said, we've dealt with companies like you. We even allowed a company, Angie's List, to maintain their Indiana-based LLC form throughout this deal. One of the issues that we have is that when we go to raise money again, the people that we work with on a daily basis aren't familiar with this form. So ultimately, down the road, part of our story was that, at the 11th hour, so to speak, we went through this deep discussion about whether or not to remain an Indiana-based LLC or to finally make the transition to the Delaware C Corp, so that in future rounds, it would be more familiar with the people that, our partners were going to be in touch with. So from that perspective, it felt good. We went with it because it served the needs of our current investor group, of our employee group, actually. All the owners of stock at the time, but we weren't forward-looking as we could have been to speed the deal up during the actual due diligence process.
That's good. Christopher, I know you've seen this dynamic as well. Can you just really quickly how Navidar plays in this ecosystem, and then specific to deal structure, you and I have talked about this a little bit. What have you seen? How does this compare to your experience?
So specifically on this note about Indiana LLCs and Delaware C Corps, that's spot on. So it's in markets that are more frothy, California or East West Coast, Austin, you don't see LLC structures very often at all. It's usually a Delaware C Corp. And the biggest reason is that the larger, more sophisticated VCs that have billion-dollar funds or multi-hundred million-dollar funds, they're investors, they're LPs. They can't deal with this pass-through taxable income deal. So probably a lot of people here are familiar with getting these K-1s, right, on April 14th. That's like crazy talk, right? So that's one of the biggest reasons. They're just not set up to deal with that, and so it's an abnormal thing that when, especially any company here, we actually a lot of times recommend you start out as a Delaware C Corp. Now angels don't like to hear that because, the losses, right? The benefits of that. But it's kind of a trade-off. We see a lot of companies make mistakes when they set up those LLCs. It causes issues when they try to jump over the creek to the next side, right, to Delaware C Corp. And a lot of issues and consternation. And so, but it's every once in a while, so it sounds like they let Angie's List do it, right, and kind of regret it probably. Every once in a while.
Change it later.
And still have to change it later, and it costs a lot more money and all those types of things. So that's kind of the biggest reason why.
One thing Battery shared with me is it was interesting. The reason that they even thought about letting us move forward is because they had their own in-house counsel. And what he shared was that all the VC groups that he'll work with to syndicate the next round don't have in-house counsel. So for us to come with a biz type that they're not used to dealing with on an everyday basis means that they have to go out and find counsel to get them through the deal as well. It's much easier to show them something that they're familiar with.
And one other final note, I've even seen situations where you have two great companies that are kind of somewhat theoretically equal. They have similar capabilities and growth rates and those types of things. But one company has some baggage, and one company is nice and clean. Too much brain drain, right? Investor goes with the one that's clean and shiny, and let's move forward.
and many of you already know this, but the LLC structure, you mentioned pass-through entity before, so as a result, the losses of the company when it's young can be passed through to the members of that LLC, which would be the investors or the executives of the company. And so as a result, they're able to carry those losses to their own tax returns and thus mitigate their taxes for that year, thus the advantage for the LLC. And that's where a lot of attorneys, they say, hey, go start with the LLC and then flip to a C Corp when you're approaching this kind of scenario.
Yeah, so now that we're getting in the weeds a little bit, I think it's a perfect time to talk about this notion of incentive units as compensation for early employees, early contractor groups that help you during your cash-strapped years. So incentive units are much like options as they are a percentage of future profits, right? But when someone hears the word unit or hears the word share, they ultimately think they're getting a percentage of the company at that time. They're getting an equity stake. That is just not the case. So when you're going to make the LLC to C Corp transition, and on the one hand, the legal group knows that you were extending incentive units, you also have a group that thought they were receiving an equity stake in the company. So to be able to transfer their stated interest into the new C Corp was weeks of work that could be avoided. So that we're in the weeds, if you're using something like incentive units in an LLC format, be sure that everyone understands the instrument when you use it, or you will uncover heartache when you go to make the transition.
So good to get some legal help on the front end so that you
Absolutely.
don't create issues later on. Good. Christopher, when some of this, well, let me tee this up with you guys first, and then I'll flip over to Christopher. So a lot of times, this stage in the game, you have options, right? Options for which VCs, but a lot of times also options for an exit, at that time. And so you're making a bet on, do we push on the gas more and look for something greater in the future, or do we make a decision right now? Are there any kind of decision points that you would share, and why did you make the decisions that you did?
You go first.
Yeah, at the time that we were really aggressively pursuing the option of a venture round, we had two public companies showing a very, very high level of interest, to the point that multiples have been discussed, and they're the multiples we all like to dream about, the 10x plus. That said, it's funny, you have a goal in your mind's eye as a founder, as investors, when you come on board a business. And from a financial standpoint, that my minimum goal was within grasp. And for me, that was a horrible awakening, because I had really started the business very pragmatically. I wanted to create an event, a financial event in my life. But when that was suddenly in front of me, I wasn't happy with it. There was more left to do. And what had started as a venture with financial ends has become so much more. So for me, I was actually, it was a hard decision. But frankly, there's a much bigger pie out there that we're positioned to claim. There is a lot more reward for our investors, and frankly, there's a lot more benefit that we can bring to our local community as well. So, I'm pretty thrilled with the path that we took, and I'm sure you can share some additional details and your own thought processes around other venture groups, as well as obviously.
Absolutely. So
The
I'll start with the
opportunities.
other venture group part, and then I'll talk a little bit about why we went the venture route instead of possible acquisition. First and foremost, along with that idea of transparency, when you're establishing this partnership with who you're working with, there's this unstated agreement of who they're dealing with versus who we're dealing with. Everyone's expected to play fair, so to speak. We were working with a couple of VCs who had portfolio companies that were potential long-term competitors, so they backed out. we were always very open with all of the groups that we were working with because we didn't want to end up in a scenario where it would be tough later. Getting with a portfolio that has 3 like companies with competing initiatives and the same partner on the board is probably not a good place that we'd want to be in a year or 2 from now. So it was important that once we decided why we picked Battery, it was important to also let everyone else know that, in fact, that was who we were going to move forward with, no matter how long it took. There's a realization that comes with that. So once you select the VC, you've already told the others that you're going to move forward with this particular one. You are in the boat for the long run until the deal's done.
Pre-approval.
This is pre-approval.
Wow.
So it is a very transparent game, and I think it has to be because the value that they bring post-close. It is truly a partnership for many more reasons than cash, much more than it's just a financing source. I'm sure you can speak to that in just a second. So the other piece of this is why we went VC instead of acquisition. And the answer, quite frankly, is run rate. How long can we sustain our business without funding of any kind to be able to wait for a large company or the Titanic to make a left-hand turn? It could take months for an acquisition to finalize. And that was a large contributor to the decision that we had to make. We got to a point where we knew that funding had to happen, whether it be from our existing angel group or from a VC group, in order for us to be alive when the acquisition paperwork finally was signed.
Christopher, what are your suggestions for evaluating that trade-off?
So I think it comes down to kind of 3 things. Personal assessment, right? Big one. Growth risk and market risk. And so it's, the hard part's the personal piece. So we'll take that out because it's different for everybody, right? So so naturally, with an investment, you're going to take on dilution. So how can I grow through that dilution? What are my odds of doing that? How long will it take me to get to that next milestone of valuation? What do I think I'm going to do at that point? So do you see what that looks like? Then you size yourself up with your competition and look at your market risk and your sector risk and what do I have, right? Do I have a platform that's serving many pieces and parts, or am I a feature, or who am I in this market pool? And I think when you go through, and it's still much harder than it sounds like, right? You go through a lot of consternation trying to figure those things out, and then you try to make a decision. Usually, the right decision will kind of percolate to the top. I would also say that we've worked with companies where we've run a dual track process, right? And so that's not necessarily uncommon. You got to be really careful and be really smart about executing that. But that's not uncommon either to consider both routes kind of simultaneously.
Are there specific metrics, as you look at multiples of revenue or revenue ranges that you say there's more sweet spot for VC versus sweet spot for kind of acquisition and ultimately capitalizing on financial opportunity? So if you're high growth, and we like to use the word sexy, right? You may talk about valuations for a minute. So we don't see a big difference in valuations necessarily when we're working with a company in high growth, in super growth mode versus an exit. There might be some small differences, but really the difference comes into what's your growth rate, what's your customer churn, what's your customer concentration, what are your margins, these types of things. What do your agreements look like? Are they month to month? Are they 1 year? Are they 3-year deals? And mix of pure play SaaS versus services. And so to bring that now back into like real terms, and this is kind of a blanket statement, right? But if you have all that sex appeal of all these different pieces and parts in your business, you will see kind of a 6 to 10x forward-looking revenue kind of valuations. And if you start to get a decent mix of services in there, right, 40, 50%, something of that nature, that will lend more towards a 3 to 6x forward-looking revenue. And so it's kind of about a 50% difference if you start to layer in a bunch of services from pure play SaaS to service. So and then when would you do it metrics as far as
It depends, right? It really, it's hard to say. Those are kind of the high-level things to think about, but it comes down to founders, to what the angel's appetite is, to if you start to take on the VC money like a sophisticated group like Battery, right? There's so many things that those groups can do for you that are unbelievable, right? In putting you on a different stage nationally, internationally. That your odds of success will, just by that in of itself, will vastly increase. So now the next decision is going to be even harder than the one they just made.
Yeah. On the metric front, you reminded me a couple of ones to pay attention to. So when we were working with Battery, the number for services as a percent of total revenue was right around 15 to 18%. They said something larger than that would lend to an agency or or more of a services play, which would lend to the lower valuation. And then they also said that...
So they saw that as a natural complement to a SaaS business as opposed
Yeah.
to being a services business.
Correct. Even with the creative ways to blend it into your subscription amounts and build it into your contracts, you will still pull that out. Around 15 to 18% is the number that they were looking at. They also look at adoption rate. So there are a lot of companies that say that they're a SaaS tech company, and if they don't have the adoption rate to prove it, then in fact they're an agency. So that would be another metric that I don't know if he shared explicitly, that when you're going to value yourself as a SaaS versus services-based business, if you don't have the adoption rate of your platform or software to back it up, that is certainly a number that they'll want to dig into.
Can I throw another big one on there that Matt will appreciate with his background? So I talk with a lot of folks about revenue recognition. And maybe it's not a big deal on day one, but this is such this is a massive issue that many software companies don't think about or pay attention to. And so when I talk about revenue recognition, so the sheer numbers of just Battery alone, of the companies that they're tracking, right? The big funnel, and you want to work yourself down that funnel. They're benchmarking you against your competition, against your peers, and against every deal they've ever done, against every deal they've ever seen. And so if your financials are not in order and your revenue recognition is not set up properly, and they can't track you with GAAP revenue so they can truly benchmark you, you're either going to get tossed out of the pool, and they're not even going to mess with you, or it's going to come back to haunt you in a massive way called valuation.
Yeah. So they called it the gap lag. And they expect the gap lag to be about 90 days. So that is the time that you book ARR to the time that you can recognize that revenue should be about a 90-day period. Reasons for that 90 days to extend are things like implementation time or time for true user adoption. When is that service or that software as a service actually recognizable? They want to see that 90-day window or something less if possible.
So we've talked about valuation a couple times. Walk us through the dance, the kind of the positioning, the narrative of how all that went down, and what strategies did you employ, and then what lessons learned did you have on the back end as you negotiated for what Smarter Remarketer was worth?
So it starts starts post letter of intent. You start to dig into the ARR bookings number. They have, multiple formats that they're used to seeing. So, at times when we were working through the casual conversations with 4 or 5 different groups, we had 4 or 5 different formats that they wanted to see. It was really their way or the highway when it came to formatting. So just be prepared to show your information in a number of different ways. But it allows you to start to build credibility early when you show that you're willing to put in the extra amount of effort to meet their needs. And so post-letter intent, we start digging into the revenue. We start digging into the true valuation metrics. We're looking at each deal by deal. What are some high-level terms that they care about? From a bookings perspective, what does that look like? So we started off with a bookings valuation, which is essentially all in what's the value of the contract on an annualized basis at the day of contract execution. So you start there, you start to go through the weeds a little bit, work out some of the ins and outs, high-level pieces of the deal, and then you start to revisit it every 2 weeks. They want to see what's happened lately, what changes have been made. Churn metrics, has anything fallen off since the first time we've talked? We probably had 10 to 12 of these weekly or bi-monthly reviews of what those numbers were looking like. I would say from that perspective, the faster that you can get the deal done, the better, right? Because no one really knows what's going to happen. You can hope, but you don't know when things like churn, might be following you, or deals might start to slow down for reasons that were unforeseen. So that kind of goes back full circle to the C Corp LLC decision early on, when what are the factors that made the deal take longer to close. Thereby it make us more vulnerable for changes in our ARR position, and that LLC format was one of the major drivers for that. So the back and forth happens. They start to dig deeper. It isn't until later in the game where they ask the revenue questions. So they say, what's that gap look like? If you're saying that you've booked X, how long does it take for you to recognize that revenue? And they start to dig in a little bit and make their own, gap-related adjustments to that valuation number.
Christopher, what would you, from looking at the other deals that you've done, what works well, strategies, tactics, recommendations for how to handle that, how to prepare for that discussion, and then also how to handle it once it happens?
So in real estate, it's location, 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 and in this scenario, it's prepare, prepare, prepare. So what I mean by that, get your team around you, right? Get your attorneys spooled up, get your accountants spooled up. If it's appropriate, get your investment bankers spooled up, and get ready. So that's everything from your legal documents, having them squared away, your financials, having them squared away. Because any of these metrics that you put out from the beginning, you can never, ever pull those back. Those will exist for at least 5 years. So if you don't do a deal and you go back in 2 or 3 years to do a deal, those metrics still exist. They will remember, they're on their own file, they've got them, right? So another piece of preparation would be the sales funnel, right? So having a very defendable grasp on your projections of sales and revenue. It's really easy to, well, I shouldn't say it's easy. It's never easy. But it's easier at the early stage to put up high growth numbers, right, from a percentage year-over-year growth standpoint. The larger you get, the harder it is to sustain that without incurring a lot of additional cost. And so a lot of companies very easily understate what their costs will be to maintain a certain revenue growth, because you have to put a lot more opportunities into the funnel for those to turn into revenue. And so those are usually vastly understated. And so those are some big puzzle pieces that would be put together before you ever show an investor, venture capital group, potential acquire anything. What Smarter Remarketer did is great. That we always encourage people. There's always the people side component to this. And so by engaging and talking with various VCs early on, before you were probably ready to think about doing anything, that is critical as well, right, to establish the relationships and the comfort level. But having that foundation put in place from the legal side and the financial side and the sales side and all of that being very defendable and be ready to go, and getting them as far through due diligence before you actually discuss and execute a term sheet is critical.
I would be surprised if there isn't something you could Google with due diligence checklist in the byline that couldn't get you almost 90% of the way there. It takes a while to make sure every piece of documentation that they'll request is ready to go, from dual signature all the way to proper formatting, all of that. And like you said, that's on file for 5 to 7 years. So you want to make sure that that's squared away as early on. You don't want that to be the reason that something takes longer. But also, I think it's important to have your team ready and to do a great job of assessing yourself out into the future, because this goes back to credibility. I think credibility is the number one most important thing to establish during this process, because these are your partners moving forward. They will sit on your board. You will answer to them on probably a monthly basis. They're injecting you with capital. They have expectations that go along with that. So building that credibility early and often, hammering it back home, I think is extremely important.
So last night I came up with a little acronym. I was thinking about this when we had our last conversation. So REST. So if you want your investors and your VCs to rest at night, which means everybody will be happier. And so replication, exit, sustainability, and team. Those are 4 of like the most important categories that everything falls into when they're looking at a company. And it's not enough time here to go into some of the nuances of that piece, but anyways, I kind of like my acronym, so I thought I'd throw it out there.
It's ironic that they get to rest, but the rest of us don't. And I did misspeak a little bit earlier. There is no casual conversation, even early on when you are talking to, someone in a mid to top tier venture group. They may feel like casual conversations, but every metric that you give. So how's that sales funnel looking? Any big brands you're working with? They'll remember it all. So to the point, even when you're throwing out numbers casually, there's nothing casual about it.
Yeah, don't throw out casual numbers, right?
Exactly. We made sure that the numbers that we shared, even socially in circles with those that we needed to share numbers with, were well thought out, were well documented, were reviewed by the team. It was one of my biggest challenges. I'm the creative guy. Thank God I have Tyner. But so again, there is no such thing as the casual conversation. They're typically well engineered. Just come and be yourself, but bring the numbers that are going to matter. Bring the brands that you know you're going to close them so that the next time a casual conversation happens, what you're being measured on in that conversation is seen through to fruition.
If I can layer on, so talking about some real life situations to what Angel just said. This happens even when your company is at trade shows. And your sales guys are at trade shows, and sales guys love to talk. And so bankers, investors, they look for sales guys, and they ask questions, right? And so you never know who that person's talking to. They may be talking to a banker who has a client that has an eye on you.
Yep.
And so a lot of times people go to to that layer of folks and not the CEO or the CFO or the whomever, because they know that they're going to be more reserved, right? And so literally things happen every day out in the public at these trade shows where people are learning, and it is by design, not by happenstance.
Our first 5 meetings with Battery were at trade shows. They're there to assess a variety of different companies. As they're assessing those other companies, we got introduced to Battery through other companies that they were exploring funding or had already funded. It's a very, very tight-knit community in marketing tech, and it may be the same in your industries, so just always kind of keep that in mind. The trade show was, that's a good observation.
And you got introduced through somebody else, or did they approach you?
It was an introduction through, a company that they had funded called Telium, but and that was, again, one of those casual conversations. They were also talking with a variety of other companies that they were looking at funding, and our name would come up from time to time. And one of the companies they were looking at, it was a marketing analytics company that had mentioned that we were driving some borderline unbelievable numbers. And then suddenly the conversation started getting a bit more serious. So it was primarily driven through the industry that we grew up in.
Based on one of the questions, I think we should clarify one thing, that the Indiana LLC versus the Delaware C Corp, still an Indiana-based company, just from a legal structure standpoint. Delaware C Corp, very common convention. Most all C
Delaware or
Corps
Las Vegas is what we're hearing.
are Delaware C Corps
Or
just
Nevada,
because
sorry.
of because of legal and tax treatment, but still doesn't change your guys' headquarters, location, anything like that. Speaking of change, though, there are some of these questions that kind of relate to how things have changed, are changing as a result of funding. How does it change your organization? How do you anticipate that it's going to change your organization as a result of both the extra cash and then also the extra accountability?
Sure. Well, accountability is your job.
Spending cash is yours.
Pretty good at it. Yeah.
From the financial standpoint, from the strategy standpoint behind it, you go from a bootstrapping mode where you have a pro forma based on when you're going to run out of cash to a strategy or a pro forma based on opportunity, which is what he was saying. When he talks about how much money it really takes to drive a certain pipeline. So your approach to talking about your business and to assessing the future of your business changes in that this isn't how, what can't we do because we don't have the money. It's what can we do and what results from what we can do. I think beyond that, organizationally, when you don't have a lot of money and you're in bootstrap mode, that you have a legitimate excuse for things that happen within an organization. When you get money, you no longer have that excuse any longer. So you move from everyone's wearing multiple hats, going crazy, bootstrapping, and we all have this excuse to rely on to, okay, money's no longer an excuse. Now we have to become a real company. I'll let you take it from there.
Yeah.
But that's really the transition that I think happens almost immediately after a funding event.
See, the funny thing is, I'm going to disagree with that. It didn't happen immediately. It took weeks for that concept to sink in. After years of bootstrapping, after years of having to compromise goals and vision for what is attainable based on a limited amount of cash in the bank, to wake up the next day, literally, Tyner sent out a real-time snapshot of our bank account right as the funds hit. It went from here to here. And it's startling because it happens in the blink of an eye for your bank account. But for you as a company, it took us the better part of 5 to 6 weeks to go, we have to stop thinking the way we used to. Mm-hmm. And it was surprisingly difficult. That said, once, for me, when I realized that the cash was there, it meant that everything that we had wanted to do suddenly became possible again. So it moved into a huge reprioritization mode because you had all these concepts that you had written down on the back of napkins, shoved into a filing cabinet, and now suddenly you needed to reassess them all. You needed to move through a prioritization exercise, which we've certainly done in product and services, in marketing. And, and it really speaks to, we just wrapped up our first board meeting with Battery, and it was outstanding because not only did they understand kind of where we were at, we're on the springboard getting ready to leap into the air, noting that my vertical leap would be, anyway. But with Battery, and the reason why I was personally so enthused about them was unsolicited. We let them know about some infrastructure architecture questions that we were wading through right now. They offered to rally. They have an internal organization at Battery that is infrastructure, architecture, big data. They're like, bring the team out. Sit down with them. We'll have the conversations. We are your partner. And while obviously we were looking for funding, gaining a partner like that with their reach, it is truly game-changing for us. And it's going to mean a lot, again, for our business, but as it steers some of the decision-making, as it influences, which we want that influence, it's going to have impact that radiates out from our company and, again, into our community. So I'm pretty enthused. Neeraj, who sits on our board, is actively working with us and Mike to try to be in town to participate in things like this. As we time board meetings, and he is one of the busiest people I've ever met in my life. So again, it is this concept of partnership, and it's a massive change once the funding hits, with a lot of nuance to it that I don't think a lot of people would appreciate.
We have a couple questions. I know this gets a little bit delicate, but if you can help navigate through this, that change,
Yeah.
also has an impact on some of the founding employees, has impact on previous investors. What should be expected, or what does that change look like for some of the people who were involved in the business earlier on, and now maybe paradigm shifts?
I mean, for our earlier investors, for our early employees, I think unilaterally it means bigger opportunity. It means that there was a vision that we had early on when we started the company that for 3 years felt like it was less a vision, more of a dream, as you're bootstrapping and you're growing and you're fighting for every dollar. But with that vision that's now attainable, there are dollar signs associated with it. And this isn't going to be a small dollar sign. So I think it's a rallying point around the opportunity that is tomorrow. And if you've really spent the time and been honest with yourself as a company, done the due diligence, cut deep into the industry in which you're living, and can paint the picture that this is attainable, then it's a far easier pill to swallow than, well, I think we're just going to tack this way and see how it goes. I mean, it's a defined market opportunity, and we are pursuing it aggressively, and the dollars will be there.
I've had this conversation with others as well. There are two sort of distinct sets of entrepreneurs. There are those that grind toward the thing in front of them. There are those that say, hey, there's this step and this step, kind of the really, and from an execution standpoint, it's very important, right? And can say, well, we got to this point, now we're going to get to this point, versus, and then you have another set that say, here's the big opportunity that's all the way out there, and we don't necessarily know exactly how we're going to get there, but we're going to kind of embark on that tack. And that's obviously has a whole component of risk to it. And a lot of startups fail, in trying to navigate that. But at the same time, it's that subset of ones that can ultimately win big as well.
Well, Mark Schuster is an investor out of L.A., and he wrote a blog post. It was a few years ago, and it always comes to mind. It's, why are there never any enterprise software startups? And it's to your point. You have to be both if you've got your eyes on a much larger prize. You got to grind, and you're always grinding towards the next dollar opportunity for the audience that you're selling into. So even though your target is a distant point on the horizon, you got to grind towards that next dollar, towards that next piece of value that you can take to the market. Otherwise, yeah, you can end with a SaaS product, but the probability of you getting there is remote at best. And that's what I think this team has done incredibly well at. There are opportunities that we pursue that align to that vision and that goal, but we monetize every step of the way.
That's great. We got a couple more minutes. Something you guys mentioned earlier on, there was a request to go into a little bit more detail, and that was the transition problems of incentive units. I know that gets a little bit tactical. Is it something that we can delve into kind of in a couple minutes to talk
Absolutely.
a little bit more about what that means and then how best to navigate that transition?
Yeah, definitely. So I think the last place we landed was the importance of understanding from an organization what it is you're dealing with. But more importantly, I think it comes down to communication, right? So it's very important that the recipient of those units understand what they're getting so that you don't walk into any scenarios where they have the paperwork, they have what you thought was understanding of what they were getting, and it's different than, in fact, what they received. That comes down to a personnel issue, in which case you have to, handle delicately. You can't necessarily tell, the batteries council that, the paperwork is what it is, and we'll take care of it with our employees. The conversation's more like, this is truly what our team understood they were receiving. So we have to figure out a way to make this right, or this is a deal breaker. And so from our perspective, it wasn't as easy of a transition as, okay, percent of future profits times every time that you've ever granted it. Okay, these turn into common immediately, and it's all clean. It was, these are actually equity shares or stake in the company at that time. What does this mean? How can we use things like restricted stock to sort of come up with some loose equivalent to making this right? One thing that they always said was, if we're going to make the C Corp conversion, we want 3 classes of stock. We do not want 5, 6, 7 instruments on our paper. So being able to get the 5 or 6 different instruments that we had on our LLC paper to down to 3 classes was much more of an art than it was a science. It takes a lot of counsel hours on both sides. It takes your accountants, your legal, accountants. We had people from all Big Four sort of calling in, giving us their advice. Not always the cheapest way to go about closing the deal. When you start to really add up all of the hours of advice that you're receiving to make sure that you can get it done and get it done right.
Is there a lesson learned in there? Is there something you would have done differently, or is that just a necessary part of the process?
I would say, if handled correctly, it could be extremely beneficial. If you elect to go with the LLC, if you elect to give your employees and your contractors and your board members and your advisors equity compensation, that's the best route to go. I would just make sure that on both the giving and the receiving end, it is very clear what everyone's receiving. You can speak to whether or not that's a good decision or not.
Well, we're a little biased maybe because we deal with clients later stage typically, and so we'd love everything to be a Delaware C Corp in 3 classes and very clean. The reality is that's not going to happen always, right? So I think the clear, and the other word I'd add to that is clean. So you can still, in these situations, have an LLC in that situation that's very clean. So, I mean, it also goes into non-voting, right? I mean, this is just a piece. That's it.
Equity, but you don't have say
Right.
in business decisions.
And it's documented, right? So people forget sometimes to put in these non-voting pieces, and all these documents are signed. And we had a deal once where we had to go get, I think it was like 150 signatures.
Wow.
To close a deal all over the world. That's not easy, and the deal almost fell apart because of that, right? And so back to when you're going to go to close mode, you want to close. Every day that deal doesn't close is a risk of it doesn't close, and you got to start over from ground zero. I'm aware of another situation that company didn't have their revenue recognition things all nice and neatly packaged and ready to go, and went against someone's advice. Mm-hmm. And when the offer came in, extremely high offer, their numbers fell apart, offer reduced about 20%, still an extremely high offer for this opportunity. And while the audit was getting put together and finalized and all these other things were happening to get to closing, the acquirer was acquired. Deal's gone. Right? And that's after a year or 14, 16 months, gone. Right? Companies still exist today, and they're still trying to grow and things, but that can happen. It was big money.
So you've used a couple terms, one being the acronym that people are liking out there in the Twitter sphere.
Do I need to get copyrighted?
You've been asked for a repeat. Repeat the four factors in your acronym.
So replication, exit, sustainability, and team.
One more time.
Replication, exit, sustainability, team.
Perfect. So guys, one of the last questions I want to ask is, what can we do to help? Stage you're in right now, looking out at big growth numbers, both revenue and customer acquisition, but also team growth, in kind of talent acquisition. What can the folks in this room do to help you guys get there?
I would say we have to put forth concerted efforts to foster talent in the areas in which we need it.
Which are?
Well, I mean, I think we're all slightly different. Areas that we're investing heavily into, seasoned marketing talent, and whether that's through universities, through secondary education vehicles here in town that could be made available. Certainly internships compelling. And then it's really kind of the next generation of technologists. Machine learning is going to become increasingly important. Predictive analytics and what we do is one of our biggest differentiators. It's wonderful to consume huge amounts of data. It's even more wonderful when a machine can make it mean something, which is core to what we do. Purdue has some great programs around this. Most colleges do. And what happens is they churn out amazing talent that then moves away. So we just need to really focus on grooming the talent that we're going to need, and for all of our sakes in this room, we gotta put the best foot forward in retaining it. And I don't have a magic answer for that. I mean, the allure of Silicon Valley is pretty compelling, but the flip side is we live in a great city, great state. We offer a lot of value, an amazing lifestyle, but that's one of our biggest challenges. I mean, as I look at what can hurt us in the future, it's the same thing. It's the same risk that we all have, making sure that we have the best talent possible made available to us.
How about customers? Who are you looking for? What are your targets?
We're still growing. We're still rapidly moving up. Kind of the retail food chain. So started with a lot of smaller retailers that, frankly, most of you in the room hadn't heard of, and we continue to grow, closing again larger and larger top tier retail brands. Is that fair?
Mm-hmm.
Okay.
Yeah. A couple. So also, Christopher, this might be helpful to the group. We talked about valuation multiples. You guys have done some really cool research on historic valuation multiple expectations. Can you give the quick thumbnail on, for companies of different profiles, what they should expect and what they should be positioning for?
So our data is based on the people who are hitting on all those cylinders. So pure SaaS play, 6 to 10x forward.
Software as a service, by the way. Yeah.
Forward-looking revenues, and you get into that mix of services and SaaS, then you're looking at kind of a 3 to 6x forward-looking revenues. And I just want to add one key point quick. Forward-looking, make note of what that means. It's not LTM, not last 12 months. It's not EBITDA, right? Your high-growth tech, you are looking at the future, and that's how you want to orient investors, is to be thinking about the future, not anything else.
Very good. So last, before we close, we've probably unpacked as many questions as we have, as solved them. So I know there are probably a lot of folks that have questions about acquisition, fundraise. Christopher, can you hang out for a couple minutes if folks do have questions? You guys as well.
Sure.
Also, angel investment. I know we have some angel investors in the room today. Also, feel free to talk to me if you have a company that's ready for that, or if you're looking to raise. Certainly talk to Christopher as well. Some of these have legal ramifications. I know we have some experts in the room too. Dave being one of them. He's here as well in the back of the room. So feel free to seek us out. As far as other kind of educational resources for those of you that are in this stage and want to take it to the next level, we also have some of you may be familiar with our entrepreneur boot camps that TechPoint's done for quite a few years. We're doing something a little new this year. We're going to break it out into a series of boot camps, and we're doing it in partnership with John Wexler and Launch Indiana. So we're going to kind of tag team on this, and we're doing it not only in Indy but also throughout the state. So for those of you elsewhere, look for them coming as well. We have, John, I had it right here. Here we go. Okay, May 14th is on Lean, the Lean movement, Kyle Shipley, and that's in Terre Haute at the Children's Museum for those of you who are remote. And then here in Indy on May 29th, planning for a successful exit, Jerry Hayes, who many of you know, and that's going to be at Launch Fishers. You can register at launchindiana.org or also on techpoint.org, where we'll link to registration as well. So have a great weekend, guys. There's a little event called the Mira Awards. It's happening tomorrow, which we're gearing up for. It's going to be a great time. I hope to see many of you there. Thanks.